How will AI change financial risk management? And how are financial institutions going to be impacted with the rise of AI, and what does that ultimately mean for us, the consumer? All right, that's what we're going to be going into today and more on Everyday AI. Welcome. My name's Jordan, and this is your daily podcast, free newsletter, live stream, helping everyday people like you and me make sense of what's going on in the world of AI and how we can actually use it to grow our companies and grow our careers. So, we're going to be diving into what's happening in the world with financial risk management and how AI is impacting all of this. It's super interesting because AI has been used very widely for many decades in the financial institution, but recent updates and features, I guess, in generative AI are going to be impacting financial institutions as well. So very excited to get into that. But before we do, let's go over the AI news. And as a reminder, if you're joining us live, like we have here, Dr. Harvey Castro joining us live, Christy Slack joining us live. Thank you. Get your questions in. What do you want to know about how AI will change the financial risk management sector? All right, let's get going. Go over AI news. We're actually just going over two pieces today because they're bigger pieces. But as always, there's more news. Go to youreverydayai.com. Sign up for the free daily newsletter. All right. So the White House has released the U.S. government's first ever executive order on AI. So President Biden unveiled a new executive order on artificial intelligence that aims to address safety concerns, protection of civil rights, and support for workers in the industry. So this new executive order involves creating new standards, protecting consumer privacy, promoting innovation and competition, and also collaborating with international partners. This executive order is the first binding action ever taken by the US government on artificial intelligence and includes regulations for large companies to share safety tests with the government before release. That's an important part. We'll see if that happens. Also, this prioritizes the development of AI standards for testing and watermarking, as well as guidelines for agencies using commercially available data. So, pretty big announcement. Again, we covered this last week when the news came out, but this executive order was just released, and we're going to have a lot more on this one in the newsletter today. All right, our second piece of AI news and last one for today, some new ChatGPT updates. All right. So nothing official yet from parent company OpenAI. But if you've paid attention at all over the last 2 or 3 days over the weekend to the internet, to social media, you'll see that ChatGPT is already starting to unveil some pretty big updates. So many users are now sharing these new updates, and probably 2 or 3 of the bigger ones are a reported updated knowledge cutoff date of September 2023. So this has already changed once. It went from September 2021 till January 2022 for GPT-4, the paid model. But apparently now it's being rolled out. The knowledge cutoff is all the way up to 2023, as well as kind of the other big feature or the big announcement here is the all tools mode, which is essentially being able to upload photos, PDFs, receive DALL-E images all inside one mode. So without having to flip back and forth between multiple modes. So really getting the first taste of multimodal in one single chat versus having to, go into multiple different modes. All right. A lot more on that later in the week. We're actually going to have a dedicated show on new ChatGPT updates and the future of ChatGPT with the developer conference coming up this week. All right, but you didn't tune in to hear about ChatGPT, and you can again always go to youreverydayai.com for more on that. You are here to learn about how AI will change financial risk management. So I'm very excited to have today on our show, and please help me welcome. There we go. We got him on the screen now. Sandeep Maira, the founder and CTO of Raven Risk Intelligence. Sandeep, thank you for joining us.
Thank you so much for having me. Really, really honored to be on the show.
Yeah, absolutely. Let's start high level real quick. Just tell everyone a little about yourself and about what you're doing at Raven Risk Intelligence.
Yeah, so I'll keep the part about myself pretty brief. My background's in computer science. I actually took an AI class at Cornell 30 years ago. It's kind of remarkable when you think about what's happened, recently versus the last 30 years. And one side anecdote was in that class. I took out the textbook from the class. I still have it a few days ago, and it said there's a small section neural networks, which is what LLMs are based on and ChatGPT is based on. And it said, like it's not showing much promise yet, but the neural network researchers think that with enough computational capacity and data, it's going to emulate human decisioning. And it said only time will tell. It actually said in the textbook, only time will tell what actually happens. So anyway, so basically, I think there was a long AI winter. I mean, in the meantime, while I had an interest in AI, more broadly had an interest in analytics. I worked at a lot of financial firms and applying essentially, I would say, algorithmic techniques for financial risk management in particular, and some trading systems. So I've worked at JP Morgan, Citigroup, BNY Mellon. And more recently founded earlier this year an AI venture called Raven Risk Intelligence. And I'm happy to talk a little bit about the objectives of the venture, Jordan, if you want me to go there next.
Yeah. Let's just go high level. Let's just talk about a little bit about what it is so everyone can understand. So yeah, just tell us a little bit about that.
Okay. So essentially, I think very broadly, the three thesis is twofold. So one of them is, in the ventures actually in commercial and corporate credit lending, not the consumer credit space. And the commercial credit space, there's a lot of manual effort done by, large teams of credit analysts to try to gather information about the borrower, and including and also the economy. So it includes things like, finding out about the business strategy of the company, the strength of the management, any competitive threats to the company. And then from a more macroeconomic standpoint, it would be, things that might be happening in the economy and so forth. Now, today, basically, most of the automated information that they get, tends to be pretty static. They have to actually kind of scour essentially unstructured data sources like the ones that I'm just mentioning to come up with a view on whether this is actually a good credit or not. So our first goal is to help automate that, which will lead to actually increased ability to process more loans, and frankly, be able to give more loans to more companies by taking into account a broader set of inputs rather than just is the company profitable today or not. And that actually, frankly, I think will enable a lot of smaller borrowers to get loans more easily. And the second part of it is what we're calling predictive risk analyses, broadly speaking, which is how are things going to perform over like a wider period of time, but using fairly advanced analytics and machine learning analytics to draw correlations between different things that are happening in the industry and in the economy.
I love it. And Cindy, maybe help us also, for those of us that don't follow the financial sector very closely, let's just talk, briefly about, financial risk and risk management and kind of historically, where it's been recently and how you see it changing now with advancements in generative AI, and like you talked about, I love that you mentioned the textbook from 30 years ago and kind of the AI winter, but now we're getting to the point where, AI is really helping in that decision-making process. So like, what does that mean broadly for the financial risk management industry?
Yeah, so I think I think broadly speaking, some of the things that I think so let me just back up a little bit. The way that risk management works today, and even actually the more advanced risk management techniques, tends to be taking into account what we call structured data, and that data is things that are tabular in format, like rows and columns. So things simple stuff, frankly, like what is the revenue of the company. What essentially they do take into account some macroeconomic indicators, like what is the GDP growth in the economy, etc. And I think, and that has been the cutting edge, actually, unbelievably. Like that's the limit essentially of what their automated sort of tools in risk management can do today. And then they take those, what I call structured and the industry calls structured input, sorry, and then put them into models that attempt to make decisions about or outlooks of risk for a given, let's say, company or sector. Now the problem with that, which is kind of alluding to earlier, is that it's actually relatively narrow. It doesn't take into account things that are, let's call it unstructured, which are information pieces that might, happen, that are not, tabular in format, frankly. So an example could be that, there's a war that breaks out somewhere, like maybe in Taiwan or wherever. And these models actually can't really take that into account at all. It's human judgment that then tries to figure out, oh well, what exposure does this company have to Taiwan? And that can be A, very manual, and B, not very comprehensive, leading to frankly inaccuracies.
Okay.
So I think the objective is that, with the advent of machine learning, you can take these events that happen and basically in real time, which is pretty amazing, and then correlate that with impacts to the economy and to even individual companies.
Mm. Yeah, and just real quick, and maybe Sandeep, you can even help me better understand this because I'm always trying to learn as well. So with unstructured or sorry, with structured data, that's been used in the financial industry and for risk management for decades, right? So
Yeah.
that's where machine learning and AI gets all of these data points and they can categorize them, right? And they can say yes, this
Yeah.
pattern of data over the course of hundreds of thousands or millions of data points, we can make decisions based on this structured data. Whereas unstructured data, it's a little harder for AI models to be able to understand that and to be able to translate that to risk because it could be things that require more interpretation or more interconnectivity that may be hard for traditional AI models to perform those tasks. But that's maybe where now with large language models, where you can start to make use of some of this unstructured data and tie it to risk management or to assess risk. Is that kind of a good overview? And then if so, how do you think large language models might be able to help pull this all together?
Yeah, well, firstly, I think that's an incredibly perceptive observation,
Whew,
frankly, on your
whew,
part.
I was
Right?
worried. I was worried.
So I wouldn't say that you don't know a lot about how to use AI and risk. You probably actually know quite a lot, because I think you've connected a lot of the dots actually, which is what these models obviously are doing in terms of trying to figure out what the impact is to risk. So yes, I mean I think you're correct. Firstly, that structured data and having models, even some machine learning models, actually draw correlations on structured data has been around for some years, and they've done a pretty good job actually. So, for example, in fraud detection, whether it's credit card fraud or even trading fraud, these models have been around for a few years where they look at different patterns of behavior of, let's say, consumer borrowing. So let's say that you go basically abroad somewhere that you haven't been before. You'll notice quite often that the credit card company will call you up or even block your card from usage because they're noticing essentially an anomaly in your in your credit behavior. So that's been around for a few years. But I think what is new though is to use essentially this for other use cases and do it at a much larger scale.
Mhm.
And so an example is Silicon Valley Bank actually might be a good example. So in Silicon Valley Bank, what happened was that the Fed raised interest rates very rapidly. The bank essentially had what's called a liquidity. So that's called market risk. Rates are considered to be like market events. That led to what is called liquidity risk issues, which is that the bank didn't have enough money, cash on hand, to actually satisfy all its depositors, because banks take depositors' money and loan them out. They're not just sitting in the bank because they have to earn interest for the bank so that they can pass that interest on to the depositors. So they had what's called a liquidity risk issue. And because of that, they had what is called a credit event, which is the bank essentially, for all practical purposes, defaulted, right? Which is essentially meaning that they could not satisfy, their creditors, who actually their depositors are their creditors in this case. So that I think that interconnectivity would have been much more easily apparent with the use of proper training of AI models and how different risks are interconnected to each other. And I think what happened at Silicon Valley Bank would have been almost completely predictable with the better use of this interconnected AI models that I think you're talking about. And large language models in particular, just to double down on that part a little bit, are actually really good at that. So they basically, I know they're called large language models, but underneath the covers, what they're doing is looking at, connectivity and correlations between different things, and then figuring out essentially, what to so-called generate. And that's why it's called generative AI. But you can use that not only just for pure language, but you can actually use it for drawing, correlations and patterns essentially between all kinds of data sets that was not achievable before. So I think those large language models can be and those techniques, I guess, the modeling techniques that are used in LLMs can be very useful for, risk analytics as well.
Mm. Yeah, and hey, as a reminder, if you're just joining us live midway through, we have Sandeep Maira, the founder and CTO of Raven Risk Intelligence. And if you have questions, please get them in now, so we can give Sandeep a chance to answer your questions. And Sandeep, I'm so glad you brought up this Silicon Valley Bank kind of collapse, because I think that's maybe one of the most relatable for many people in terms of financial risk, because we saw, unfortunately, things go down an unfortunate path for many involved. And I think some of the initial response to that is people said, "Hey, with all of this data, with all of this, artificial intelligence and machine learning, how did this happen?" And you kind of started to, help us solve that. It's, kind of different, I guess, models or different sets of data that maybe weren't talking to each other. So, with even generative AI, I guess, that could potentially help solve this in the future, what are still those obstacles to overcome until we can have, generative AI, help kind of, quote unquote, connect all these different, pieces of data or these different models together? What do we still have to do? And then maybe even what are the risks of doing that?
Yeah, no, that's a great question. So, so firstly, I think, these models are only as good as the data and how the data is essentially presented to them. And so, they're not magic. I mean, they might seem like magic, but the reality is that all even ChatGPT is doing is it's taking all the data on the internet and, trying to do its best essentially to come up with what makes sense from an output perspective. But not everything is on the internet. So particularly, I think in some of the business domains, like in commercial credit lending, a lot of the a lot of essentially the inputs actually come from human inputs that are not codified on the internet. So for example, like you might have something that is somewhat subjective about essentially let's say that there's going to be a change in the business strategy of the company, as an example. And then quite often there's a subjective decision made by the bank about does that business strategy lead to potential risk to the company or not. And how big is that risk, and I think so these large language models are not yet at the stage where they can codify things that are, and even come up with correlations for things that are not readily present in the data. And so what's called human reinforcement learning, there's actually a couple of terms for it. One is called long long-winded term. I mean, these guys come up always in the space with very long acronyms and unobscure terms, but it's called reinforcement learning with human feedback, RLHF. And that actually is a pretty hot area of even research, ironically, is to actually get humans to at least partially train the more obscure and more critical parts essentially of these models, because the impact of these models and business decisioning can be pretty severe. So somebody could be denied a loan, for example, and could actually mess up their business
Mm.
if the models present data that is outputs that are not completely accurate. So that's one thing. So that's, I think, one thing that I think is like a challenge. But I think there's some ways, like I said, it's an active space, is to take these automated models and LLMs and ChatGPT like models, but then apply some human oversight and inputs onto the modeling process. The second one is that in finance, and particularly in regulated finance like banks, they tend to be very highly regulated. And so the regulators are very nervous about using machine learning, frankly, in general, for decisioning purposes. They've started to get somewhat more comfortable about using machine learning for using structured data, particularly for things even like consumer credit. But they're not yet there in terms of using unstructured data and machine learning to come up with decisioning. I think we all know about, many of us know about hallucinations. So these models are not completely accurate. Quite often, frankly, if they're asked very specific questions, they can, some of the data is inaccurate, which is frankly not acceptable in the finance space. I think the regulators are very nervous about that, and probably rightly so. So I think one of the things that, I think is going to be a challenge is actually getting the models to be more accurate than they are today. So moving them from a consumer space to an enterprise decisioning space. And then getting, once that happens, then getting the regulators comfortable, which is not always easy, with hopefully improvements in in the decision recommendations from these models. And then a related point to that actually is something called explainability, is that the regulators and even the firms themselves, don't like black boxes. So they want to know essentially some idea of how the models came up with these outputs and recommendations based upon the inputs. So they want some traceability between the inputs and the outputs. And unfortunately today, deep neural networks like ChatGPT are not able to do that. I mean, the models are so large that it's not easy to actually trace how ChatGPT came up with the outputs based upon billions of points of input from the internet. So that's going to be another frankly challenging area as well.
Mm. So as AI can help in all of these areas, and I'm sure that's where the financial risk management, experts are starting to spend their time in. Where do humans kind of fall into this future equation, right? Like, is their job going to change? Are their responsibilities going to change? And like I said, is this maybe a good thing or a bad thing? And what are even the risks of that, as leaders working in this space are maybe using and leveraging more AI? What do we have to keep an eye on to make sure that this is successful in terms of risk management and handing these things off? Because it sounds like AI can really help in some of these areas, and to help connect some of these disjointed verticals where we have all this different data that exists. But then how does that change then what ultimate responsibilities lie on us humans?
Yeah, so basically, firstly, I think in terms of things related, I think people are nervous, certainly, and I think frankly, the more people use ChatGPT, in some cases, the more nervous they get because they see, how powerful it is, right? So people, for good reason, worried about their jobs. I even get questions from people about, what fields their kids should study in, that will be less adversely impacted by AI. So there's a lot of, I would say, valid actually questions and concerns about, the impact to social impact, but also, impact to the workforce. My view is somewhat fairly positive, at least in the long run. So, I think in the long run, things that are more tedious will be taken away, and essentially, the machine learning and AI can automate those tasks. But there are things that I think are harder actually for machines to be responsible for, that humans actually could play a bigger role. So, as an example, is even in this risk space, in the productivity um, that I was talking about. I was talking to somebody very senior at a big bank and risk, and he was saying that he's found that their credit risk analysts actually find this gathering of information and then trying to summarize it to come up with some outlooks is very tedious. And actually the turnover he's found in that part of his team is actually pretty high. So I think essentially it will remove some of the more tedious tasks and enable humans to focus things frankly that are more interesting and more value add. So I think there are things that we can do in the future that we don't even know yet. I mean, an example could be in the media space, that people are very worried about AI basically generating movies automatically and taking away actors' jobs. Now, in the short to medium term, that's a valid concern. But in the longer term, if you think about it, somebody who's very creative, could essentially, as one person, potentially in the, let's say, eventually in the future, create a full-length movie on their own, which today is very difficult for creative people, frankly, to break into, getting large audiences. It's not an easy task. I do think that there's opportunities for leverage here. If you think about it, just one last point on that, it's not completely dissimilar to the internet, where essentially people were very worried that the internet would take away, lots of jobs, particularly in some sectors like retail, when Amazon, with the advent of Amazon and so forth. But I think if you look at, another way, there were many jobs created related to the internet that, in many ways more than offset the job losses in other sectors.
Mm. One thing AI, as a super aside, one thing AI can't help is me charging my mouse battery. So apologies. I do see some great comments coming in, but my mouse actually died, so I can't bring them up. I'm sorry, but maybe Sandeep, as we look forward to the future of risk management. So one thing I maybe want to get your thoughts on is how this ultimately impacts consumers, right? Because I think if we're like if we're looking like what's actually very tangible to consumers, one thing that we probably worry about is risk and fraud. How might we the average bank consumer, we have our savings accounts, our 401ks, our IRAs, credit cards, all those things. How might we be impacted by all of these changes that we're kind of talking about? And even as it comes to risk, are consumers ultimately more at risk in the long run, or maybe are we less?
No, I think actually in risk it's a net, frankly, a net positive because I think one of the issues in the consumer space today is that people who don't have what's called a traditional credit history find it hard to get credit, including credit cards and loans. And I think by taking essentially what we're calling unstructured data sets, like for example, let's say that somebody doesn't have a long credit history, but they've got a good history of paying their regular bills on time, like the utility bills, etc., right? And they've been so I think those kinds of data sets that haven't been used today could provide essentially better, like I would call outlooks in terms of what the consumer's ability or ability to pay back essentially their credit looks like. So I think it actually will expand, in fact, access to credit for consumers who have had a harder time. Getting credit today, and frankly, that includes minority populations, or people who for through no fault of their own have had, let's say, a rough time, right? But inherently, they probably can be a good credit going forward. So I actually think it's a net positive. On the commercial space, the impact is probably less directly visible. But another way to look at it is that if companies get easier access to credit too, that essentially helps these business owners. Some of them are small business owners as well, not just large corporations. And then that ultimately helps the economy by ensuring that the economy is more productive and reduces prices for consumers. So you don't want an economy where the access to credit by both large and small businesses is appropriately allocated, because that ultimately drives what benefit and prices that consumers pay on the street.
Mm. What's so, Sandy? We covered an awful lot here. We talked about historical use cases for AI and machine learning over many decades, right? Like even going back to a course you took some 30 years ago, and then we kind of got caught up to current day, and some of the challenges and also some of the opportunities that are associated with financial risk management in the new age of generative AI. But maybe what's that one point that you would really want to stick with people, right? So whether they're in the financial industry or if it's just everyday person, what's kind of that one big takeaway that you would want us all to hopefully understand, so that we can better understand kind of where financial risk management is going now that we have access to better, more powerful, and more connected AI systems?
Yeah, I think the general point that I have, and maybe it's not just specific to financial risk management, and it's maybe somewhat obvious perhaps, but is that, I think that everybody should stay current with, the tools that are out there like ChatGPT. There's another way to think about it is that if you're not using those tools, then your counterpart may be using their tools and improving their productivity, right? So like you want to be a little bit careful from your own, I would say, career perspective as an example, that you're staying current with what the openly available capabilities are for, like, large language models as an example. Because you don't want to be put at a disadvantage, right? You want to, so my strong recommendation is to stay current with what's happening with at least the widely available tools, so that, you can use them, obviously, where allowed, to improve essentially both your personal life as well as maybe your productivity at work. So I think what I would say to most people.
Mm. Sound advice. Sandeep, thank you so much for joining the Everyday AI Show. We very much appreciate your insights.
Thank you so much for having me. Really appreciate it, Jordan. It was really
All right.
fun.
And hey, there was a lot there. Don't
Yeah.
worry if you missed a little bit. Go to youreverydayai.com, sign up for that free daily newsletter. Will not only be, hey, a lot more AI news, but just more insights and more depth into what Sandeep was talking about. Thank you for joining us, and we hope to see you back for another edition of Everyday AI. Thanks, y'all.
Thank you. Bye.